Last month, despite lower growth forecasts and contained inflation, the Reserve Bank decided not to reduce interest rates any further at this stage. And this is only adding to household pressure. And this is because our real interest rates have actually increased. So let me explain. The real interest rate is the difference between the interest rate and inflation. As interest rates are used to contain inflation, the real interest rate matters. We don't want a real interest rate that's too low, as that would encourage people to overborrow, overspend, and push up prices, creating inflation. But we do not want a real interest rate that's too high, because that stops businesses and households from borrowing to grow and invest in assets. This graphic is from the Altron FinTech Household Resilience Index. The blue bars depict the inflation rate, and the yellow line is the prime interest rate. So right now, the difference between the prime interest rate and inflation is 8.3%. At the beginning of 2024, before the rate cuts, the real interest rate, so the difference between inflation and the prime rate, was less than 7%. So our real rate is actually higher. Interest rates not only contain inflation, they also impact growth, as can be seen by this graph, where the yellow line is the real prime rate and the blue bars are GDP growth. Maybe if we're going to be debating the national budget, we should also be debating our interest rate strategy.